Well, hello, everyone. Thank you for joining us today. I'm Andrew. This is Sean, and we're happy to have you with us here for our latest installment of our webinar. So if you've been with us before, you probably know the drill of what we'll cover. If not, for your first time, welcome. So we'll take a 30,000-foot view of what's happening in the capital markets and the economy. But from a lens that we think is practical for a depository managing their balance sheet in this environment. The second thing is we'll take a deep dive into what's happening and things that jumped off the page for us when looking at second quarter financials of our member institutions here in New England. And then lastly, we'll take a look at some of the levers that are interesting to us in terms of strategic things that we can be doing on both sides of the balance sheet to navigate through this very unique time. So, we know that you come to the Home Loan Bank of Boston for a lot of different things. Some would say liquidity and funding are high up on that list. Others would say the intersection of pop culture and sports references with what's happening in the banking world. So, there's two movies out recently, Barbie and Oppenheimer, slightly different tones.
Slightly different.
One of the things that came through our minds was, if you look at the different tones, it kind of describes the deposit gathering and retention process in 2021 relative to how it feels in 2023. And if you haven't yet seen these movies, Barbie is the one on the left in pink, smiling and happy. That's kind of, where things are at. So let's jump right into talking about what's happening in the markets and the economy. So first and foremost, no surprise to anybody, short-term rates have risen comfortably above 5%. We had our first pause, skip, halt, whatever you want to call it, in terms of rate hikes in June. But then in July, rates did go up 25 basis points again. But one of the interesting things to us was looking at the reverse repo facility that the Fed provides for, if you're not familiar, the non-depositories who don't have access to interest on reserve balances, where they can transact with the Fed and get that rate. So balances have come down by about $400 billion over the last few months or so. And it's really been driven by a couple different things. One, that turning point was pretty much right after the debt ceiling situation was avoided. So there was this buildup of a lack of Treasury bill issuance that those floodgates have opened back up. So there's supply of T-bills going into the market. The other thing is that nominal rates are just frankly flat high. And we're getting potentially closer, and we'll talk about this in a little bit, about being towards the end of the hiking cycle. So there's motivation from financial market participants to term out on the asset side. Again, something we'll get to a little bit later. Now, why does this all matter to depositories, this non-depository activity? Well, I think, as we've all learned over the last year or so, the Treasury market and money market fund complex, and the money market funds are the bulk of the activity and the volume that goes into this reverse repo facility, is that they are a true competition for bank deposits in terms of the rates they're able to play and where excess funds can go. So knowing the conditions and what is happening in terms of T-bills and money markets as viable alternatives for the customer's short-term liquidity is something to take note of. So thinking about the yield curve, here is a measure going back 40 years of the steepness between the 3-month Treasury and the 10-year Treasury. Now, we've all seen and heard in many different channels this idea of, once the curve is inverted, the world's going to end, recession is right around the corner, and short-term rates are going to be going lower in short order. Hang on one second. I just want to make sure that we have the slides properly presented here. Stacy, can we see the slides now? Okay, good. Apologies for that hiccup there. So go back to yield curve for a second. So when we look back at the last 40 years, we've annotated with the arrow there the instances where this measure of the yield curve has inverted. And one of the things that hopefully jumps out, or there's two things that jump out, is one, the level of inversion that we're experiencing now is much deeper than where it's been historically. So to the tune of 50 or 75 basis points more inverted. And now, with every passing day, we're getting to a longer time frame where rates were inverted. So moral of the story is it's been expensive and costly to be too early on this bet that inversion means short rates are going down, or even long rates going down to some extent as well. So at some point, rates will go down, we think, but until we get there, there's going to be considerable impacts on being a spread lender that an inverted curve does not create the ideal backdrop for that. Inflation. We rewind about a year or so ago, and inflation was all anybody was talking about within the markets, but even to casual people who aren't in the bank and credit union world. Year-over-year CPI has returned to normal-ish levels, down to 3.3% as of last month, relative to the 8-9% that it hit early in this year. That's to be expected because of the way it's calculated, that it's coming off of relatively elevated levels that makes it difficult to grow in perpetuity at such high levels. But here in green is an interesting metric, and it's one of the key indicators that the Fed has indicated that they keep an eye on. So it's the 5-year inflation rate 5-year forward, and this is pulled out from the market for TIPS, inflation protected securities. And this measure has been creeping up slightly, such that it's at the highest level that it's been since 2014. Now, again, why is this important to managers of a bank and credit union balance sheet? Well, one, the health of the consumer and the business customers is really paramount as a driver to the business. But the other aspect of it is that, and we've seen this over the last couple months, and we saw this at the end of 2022 as well, is that when the long end of the curve gets ahead of the short end, as is typically the case, if you get into a staring contest with what happening with short-term rates and the Fed being steadfast in continuing to raise rates, then they're prone and opens the possibility of sell-offs in that intermediate and long end of the curve, which can be painful for valuations on fixed-rate assets like what we have in the bond portfolio, as well as on the lending side. So when you have this this challenge between what the curve is saying, but also what is the Fed is saying and what inflation metrics are saying, it really creates a challenging environment.
Yeah, and Andrew, one of the key ways that we've seen inflation manifest, of course, is in housing costs. And so here's a look at what housing prices have done in major metro areas around New England since the turn of the century, since 2000. It's an index that I've taken off Freddie Mac's data. So what they do is they basically take all the information for all the loans sold in these metros and then identify what the relative value of housing is over time. So everything's indexed to 100 as of December 2000, and then you see the line for each one of these metros over the past 23 years, basically. And it turns out that Portland, Maine, and Burlington, Vermont are the best performing metros in that time frame. Connecticut's obviously kind of struggled, but what's really amazing about it is that more than 50% increases in some of these metros, including those best performing ones, just in the past 3 years, and up over 200%, basically a triple plus over the course of the 21st century. So really remarkable performance over that time frame. One other thing I didn't put in here is that on a lot of West Coast markets, you have actually seen some decline year over year. So one of the questions is whether some of that will some of that end up translating to other parts of the country over time. But New England has really performed very well compared to other places around the country. But what that translates into is housing affordability issues, of course. So what I did here is to try to say, what if you were that sort of marginal person looking at a first-time home purchase that had pretty good income, and we're looking at a a potentially affordable property in one of those markets like a Portland or a Burlington. And the home price here, I assumed, was about $400,000. In 2020, it went up to the extent that that index is actually showing you, from 390 to 430 in this example. And then in 2023, now that same home, if you were in, again, one of those performing markets that's gone up about 50% in the past few years, is $640,000. Meanwhile, your income's probably only gone up 10, 12% over the past few years, which means that your down payment has to go up over $40,000 if you're trying to target that 20% down payment. And then the big thing here, of course, is that interest rates have gone from 375 to 3 back to 7. And so the P&I, including a tax payment here, has gone from an affordable 25% of income to a very unaffordable 48% of gross income. 28% sort of being that magic underwriting number that a lot of institutions use in trying to think about mortgage underwriting. So very unaffordable for a lot of folks out there right now. And so a lot of folks are getting squeezed out of the market. But if you think about that, I question, how could that be the case? How can it be the case that most people can't afford a home? Sort of by definition, if that's going to occur, you would think home prices would decline, but we're showing that they're actually still going up. So what's actually happening here is housing inventory, I suspect, is what's really driving this. And so this is a look at housing inventory as far back as they have data, going back to about 2016. And you can see that usually at this time of year, it's a very highly seasonal pattern about home listings. But at this time of year, there's usually 1.3 million homes that are on the market nationally. And right now, there's about 650,000 as of July. So we're literally at about half the level of inventory that you would normally, expect to see at this time. And so I think that's what's happening, is that there's just so few homes because people are locked into those 3% mortgages. They don't want to move. And so right now there's probably 650,000 to 1 million homes out there that would otherwise be out there, where the current owners are saying, I'm going to stick around my 3% mortgage instead of trying to find a 7% mortgage if I have to move. And I think what's happening there, ironically, is that that's forcing a lot of people who would otherwise buy homes into the rental market, which then pushes up rental prices, which then translates back into the inflation numbers. So ironically, the higher rates are actually potentially triggering the inflation numbers at this point. If you look at CPI last quarter, the single biggest standout component that still has high year-over-year value is housing, owner's equivalent rent. And that's being driven, I think, by this dynamic of almost artificially limited supply because of the rate environment, causing more renters, which drives up rental prices. So if this dynamic shifts around, if we do get a rate pivot, or I think there's a couple other theories I've heard about Airbnb and Vrbo kind of owners potentially selling some properties or turning them into rental properties to sort of alleviate some of this buildup that's happening right now. That might be catalyst for changing this dynamic, but right now it's a challenging dynamic, and a lot of people don't think it's going to go away in the near future.
All right, so that that leads us into the second section here, and we're going to take a look specifically what's happening on our member balance sheets. So we'll cover a fair amount of ground, and first and foremost, really is shouldn't be much surprise. What's happening on the deposit side of the balance sheet is the big driver of all things profitability and risk right now. So I'm going to hand it over to Sean, and he's going to come at it from every angle.
Yeah, thanks, Andrew. So obviously, yeah, everyone is talking about deposits and funding out there. And so I wanted to take a look at sort of the deposit mix that we can see from call report data. This is showing sort of the mix between time deposit CDs and non-maturity deposits since the rising rate cycle began. I'm identifying that cycle as starting Q1 2022. The first hike was in March, if you can remember that far back. There was only one modest quarter-point hike at the time in mid-March. So since that time frame, we've seen deposits, or CDs rather, go from about 13% of the overall deposit mix to about 21%, a little over 21%. And then at credit unions, it's almost the exact same numbers. It's actually kind of eerily similar, that they're 13% going to 21%. So you've seen over 60% growth in CDs over this period of time since rising rates began. And you've really seen it accelerate in the past quarter or two compared to where it started. Again, if you kind of look back and forth on these charts, you had very little reaction at the beginning, and then starting late last year. And I think this is highly related to the fact that overall deposits started to really meaningfully decline in September of last year. You really started to see this mix change on the balance sheet. And then beyond CDs, let's take a look at the overall funding mix. If we split this up between sort of core deposits in those aspects of deposits or funding rather that are not core, things like borrowings, sweep deposits, and listing deposits and brokered CDs. And what we've seen over this time frame is a lot of people had very, very little wholesale funding at the start of the rising rate cycle. Kind of makes sense because liquidity, to that Barbie slide, was very, very ample in 2020 and 2021. A lot of people paid down wholesale funding. So they started this cycle with a pretty minimal amount. For banks, it was about 6%. And now, quarter by quarter, it's been increasing every single quarter. And now it's about 19% of the overall mix is through non-core sources. And so you've seen core deposits in this time frame actually decline 5.5%. I know at the end of last year, we tried to take a look at, what does rising rates for the Federal Reserve and a shrinking Federal Reserve balance sheet mean for depositories? And we offered the idea that it's going to be really, really difficult to have core deposit growth in 2023. So when people think about budgeting, it's going to be really hard to put in a positive number there just because the dynamics are so working against everybody. Doesn't mean any given institution can't outperform, and many are, but in aggregate, it does mean that the whole system is probably going to shrink. And indeed, that's what we're seeing. That cycle to date, it's -5%. Credit unions have fared a lot better, actually, though. So in this cycle to date, credit unions actually have had core growth, 4.5%. So banks are actually down. Member banks down 5.5% in core deposits since the cycle began. Credit unions have outperformed, up 4.3%. And so what I think about there is the fact that it's probably the mix of clientele that's actually driving some of this behavior, where commercial clients are the ones that are going to the external sources, that are going into things like treasuries, and it's less so personal, or they're going into money market mutual funds, or they're spending money more so than the personal piece, to try to explain the difference here. As a result, credit unions have used less wholesale funding. So their overall mix has gone from about 3% up to 7 or 8%, and compared to banks at about 19%.
So that's a good segue into talking about the advance in wholesale usage. And as Sean showed us with the deposit metrics, credit unions have had less need for wholesale funding because they've been able to retain and grow deposits at a better clip relative to banks. So there's two things that jump out here. One we just mentioned, the credit union versus bank dynamic. So when you look at the percentage of credit unions and banks who had more than 3% advances to assets, and look at 3 different time periods: 12/31/19, that was before the cut cycle; 3/31/22, that was right before the start of the hike cycle, and then here we are today. So we can see that down, then back up path as we bucket credit unions and banks by various sizes. But at every size interval, with the exception of, interestingly, 250 million to 1 billion in assets, where credit union borrowings right now is on par with the need for advances from banks in that same asset bucket. Again, because of the deposit experience, advance usage has been lighter. And the other thing that jumps out is the size dynamic, that generally speaking, the larger the institution, the more likely they are to have a reliance on advances. So that's whether that's in excess of 3%, as maybe not considerable, but a decent sized part of the funding mix. But also looking at on the bottom panel here, members who have no advances. So you can see those credit union, those green bars, extend much further out to the right, that in each asset size bucket, credit unions, there's more credit unions who have 0 advances on the books relative to banks.
Yeah, and so as we talk about sort of that core deposit performance and sort of the funding mix changes, how have funding costs evolved over time? And so at the start of this cycle, credit unions actually were paying more on overall funding, and at this point are paying less because the accelerated costs have increased for banks. What we've seen here is that at the start of this cycle, it's hard to remember that SOFR back in spring of 2022 was less than 10 basis points. I think the average was 8 or 9 basis points. We have on the slide 9 basis points in Q1. Most recently, it was about 5%. And in that time frame, overall costs for banks have gone from 16 up to 152, and for credit unions from 35 up to 113. So we're seeing this every quarter. We're seeing the actual expense increase by more than the prior quarter, kind of makes sense that there's a significant lag, that at the early stages of the cycle, there isn't as much repricing going on out there. And then the later stages of the cycle, there's probably going to be more repricing. But it's interesting to see how this dynamic has been playing out over the cycle to date. And then the other thing to think about is sort of the overall beta. And so this is the overall beta book. This isn't just what's going on with deposit betas in a particular product, but for the overall structure of deposits, bank beta cycle to date about 28%, and for credit unions only 16%. So that's pretty darn low. I think that's really strong performance so far, but one of the questions is going to be, how does that play out over time? NIM, NIM has NIM was a struggle for a lot of people in this past quarter, and maybe a struggle going forward for some folks. 90% of our member banks this quarter actually saw declining NIM. It was only about 50% for credit unions. Again, coming back to that funding mix sort of dynamic that's going on out there. This particular chart shows two histograms here, and each one of these bars represents a 10 basis point change in NIM. Everybody to the left of those green sort of bars in the middle is negative, and then everybody to the right is positive. And what you see if you look at the bank dynamics there is that 56 and 58 are the biggest buckets between -10 and -30 basis points of NIM just this quarter. On credit unions, it's a much more mixed bag. The single biggest bucket is, is 0 to 10 on a negative NIM, but it's really kind of all over the place. And the median was only -1. Some of the credit union dynamics are a little skewed because some of the bigger credit unions actually had more NIM decline this time. But it's a situation where there's a divergence that's happening between our membership base, though the bias is definitely towards declining NIM at this point. And what's pushing it? It's deposit pricing, no surprise. Quarter over quarter, asset rates went up about 24 basis points at banks, 23 basis points at credit unions. And then the liability rate overwhelmingly is a consequence of just deposit repricing, not the mix. You can see the mix changes here, but it's overwhelmingly deposit pricing leading to those dynamics. I mean, didn't we think that higher rates were going to help profitability? They did for a hot minute there, I think. But you can see year over year changes. Again, the liabilities are actually outpacing the asset pricing over the course of the past year for banks. It's the inverse relationship for credit unions, which is leading to the outperformance for credit unions. Something else that's worth noting here is that the asset mix changes, so it's basically cash going into loans or investment cash flows that are winding up in loans, improving profitability for banks, is more than being offset by the same dynamic on the liability side, where core deposits are leaving and being replaced with more expensive funding. And then on credit unions, it's just the opposite again, where the core deposit outperformance is actually leading to a favorable mix shift and also helping the NIM change year over year. Let's go back on the Wayback Machine to actually see how this has played out over time. And you can see that NIM really did improve into the end of last year and even into Q1 for a lot of people, but in the past quarter really started to decline. And again, you see that sort of credit union versus bank dynamic going on. All right, so one of the things I think about here is to say, all right, are we done? How much further do we have to go? So we've had all this deposit repricing. We had a lot of deposit repricing this particular quarter. We think the rising rate cycle might be coming to a close. A lot of people think we're done or there's only one more hike. What could happen with deposit pricing? So I said, let's compare this cycle to what happened in 2004 to 2006. So if you can remember that far back, in the second quarter, June 2004 to the very beginning of the third quarter in 2006, July 2006, the Fed funds rate went from 1% to 5.25%, so 425 basis points of movement. This is bank members at that point in time, existing bank members at that point in time. At that point, overall deposits were higher than what the Fed funds rate. It was 118 versus 1, similar to this environment where it started at 16 versus 9 for SOFR. And then a year into it, overall deposit expenses very similar to what they are today, 164 versus 152 today. But Fed funds didn't go up quite as quickly in that time frame. It was a 25 basis point drip in that cycle every single meeting. It wasn't the 75 basis point leaps that we saw in the summer of last year. And so the consequence here is that by the end of that cycle, or in the sort of the end of the rising rate cycle, and then going into the pause, the hold of the Fed at 5.25, bank deposit expenses went into the mid-2s and almost to 3% in the summer of 2007 on the eve of the great financial crisis. And so it's something to think about is, are we closer to the end in deposit repricing, or are we maybe only halfway there? Is there another 50 to 100 basis points or more potentially of deposit expenses I think we're going to see different dynamics play out at different institutions in the coming year. But it does sound, the Fed sounds pretty hawkish, and it does seem like we're going to have a pause up here, if not another hike for coming quarters. And so we'll see how this deposit expense plays out over time. And as a consequence, probably of that, what we are also seeing from all the data that we can collect on the call report here is that more institutions are extending funding and are doing more swaps to hedge activity. So this is a look both at the amount on the lower bars of funding that's greater than a year, including structured advances. And then the lighter bars are the total notional, the total amount of reported interest rate risk derivatives that are on balance sheets. And you can see that every quarter that has been increasing. Again, probably no surprise as more people start refining some of the assumptions in their modeling to think about what could happen, what's going on over time. Bank NIM at 293, if we think about is there 100 basis points more of risk plus of deposit expenses, some of the assets will reprice. It could be another 50 basis points plus of decline in bank NIM coming up. And so I think that's what's sort of driving a lot of this activity where people are saying, no mas, we have to extend some of our funding. We have to be able to survive sort of this environment. Something else that's worth noting here is that, it's sort of similar to the advanced dynamic that Andrew was talking about there, is where the bigger you are, the more likely you are to borrow, the more likely you are to do different kinds of activity. Same thing here with hedging and with extension. We see that about half of our banks use derivatives and only a handful of credit unions use derivatives. And of our 25 largest banks, only 2 report no derivatives use whatsoever. So basically almost everybody over 3 billion, with 2 or 3 exceptions, are using derivatives in some form or fashion. And something else that I didn't highlight on the CD mix, because we're talking here about funding that's going longer. The actual client CDs have gotten shorter in the past couple quarters. And so it's tough to know exactly what's going on there, but my read between the lines on that is it's more shorter term CD specials where institutions are putting out 11-month special, 9-month specials to try to attract more deposits, and then that's driving the shorter amount of CDs. So it's a way to manage the deposit pricing exception process that we talked about in our last webinar. But it's not crystal clear exactly what's happening there, but it used to be the case until the last couple quarters that about 30% of CDs were more than a year. Right now it's down to 18% of CDs are more than a year. So that has changed as well. And then something else, hey, there was a lot of concern about bank safety back in March. I don't know if you heard anything about that. So uninsured deposits was one of the focuses, and is one of the focuses going forward to think about different ways that bank regulators and credit union regulators will look at what's going on with potential risk in your institution. So what has actually happened with uninsured deposits? Well, you can see of those institutions that report uninsured deposits, and for banks, it's only banks above $1 billion that are actually required to report this. That number has decreased from about 36 to 31%. And that's about $10 billion, $12 billion of the overall book. So, that's a little bit surprising to me that it's not more, frankly. It's clearly declined significantly in the past couple quarters. I'm not surprised by that, but the degree of that decline is probably not as much as I might otherwise think. And at credit unions, probably no surprise, more personal clients, and so you end up in a situation where there's just much less uninsured shares out there for credit unions.
So, a lot of talk has been about the deposit and funding side, and rightly so, and we're one of the people talking about it a lot. Yep. But what I think has kind of flown under the radar a little bit is how strong loan growth has been. So here we're looking at annualized loan growth, the 25th, 50th, and 75th percentile. And I want to see how we're faring now, the last few quarters, relative to 18 and 19, the last time we were in a hike, pause, cut cycle. And just to make the graphic a little bit cleaner, stripped out the period of 2020 and 2021 to give us a little white space to really lock in here. So the thing that jumps out here, there's an interesting dynamic, kind of what we talked about before with the way the year-over-year CPI changes are done. That there's an asterisk involved when you're looking at quarter-over-quarter or year-over-year changes. So the fact that loan growth has come down to that 6 to 8% range annualized in this most recent quarter. That's still a pretty good level in and of itself. The fact that it's coming down to me isn't really terribly concerning because to grow after 3 consecutive quarters of double-digit growth is pretty exceptional. When you also throw in the fact that an inverted curve, as we mentioned before, is not probably the optimal scenario to be putting the pedal to the metal on loan growth and to have it be accretive to margin. So, the takeaway here is that as we've seen loan demand recover, I think the consensus where most managers are at is that margin contraction is on the horizon. There's really no debating that. That growing through it is the path forward, and it comes down to trusting the process on the decisions we're making on the credit side of the house. So, what areas are driving this loan growth? And we've touched upon this in past webinars. Is that the residential side, despite what we can see in front of our face in terms of, well, the refi market is dead given where rates are right now, it's largely purchase market. So the fact that residential loans have been continuing to grow at a pretty aggressive clip, so 81% of banks saw quarter-over-quarter dollar growth in this most recent quarter. This tells you that when you compare you have these two dynamics of what do prepayments and refis, and how do we compare that versus a lower level of origination? Which dynamic is more important? Then maybe prepays aren't as important in terms of the ability to grow the balance sheet as we once thought. The other dynamic here is the ARM market relative to the fixed rates has picked up, and so those are certainly a balance sheet product. But we can say, because of our MPF, our secondary market program, that the activity there has been through the roof over the last couple months. So certainly there are conventional fixed rate mortgages being made. And the takeaway there is that liquidity is getting that much tighter and tighter, so that the keep sell decision, and we'll talk about that a little bit more, is skewing towards the sell. More granularly looking at CRE and autos, CRE for banks, autos for credit unions being primary categories. Steady as she goes for banks and CRE in terms of growth and activity there. Autos have cooled off a little bit, but still, growing for most. Even if it's not to the level of the end of last year when things were really, firing on all cylinders. On the investment side of things, quick thank you to, we had a summer intern here, and she was very helpful in putting together this slide, and she now knows everything about what's happening in the investment portfolio at banks and credit unions. So that was good to see. Is that this very interesting dynamic that credit unions had much shorter durations going into the falling rate cycle, and investment yields were very low. And as rates persisted at that 0% range, we got to, if you look on the right hand side, that big green section in the middle, that nearly 80% of credit unions had investment yields below 1%. But then as rates started to move up in the middle of 2022, because they had that ability to reprice the portfolio that much quicker, it really changed and rather rapidly to where about 35% of credit unions now have investment yields over 3%, which is far and away better than what we had coming into this cycle in 2020. Banks have been a little more measured in those changes, although they did slowly but surely start to see improvement. One thing that really jumps out when looking at the bank data is that the investment yield, the median investment yield, only improved by 1 basis point this most recent quarter. And that contrasts to about 10 to 15 basis point changes, positive changes going back the last few quarters. So now this tells us, right, there's 3 things you can do with the investment portfolio. You can replace and grow, you can replace, or you can just let runoff contract the size of the portfolio. So for a while, we were in not just replace, but replace and grow mode. But now that we're seeing investment yields only go up by 1 basis point in this world where most have book yields in the 2 to 3% range, and the marginal investment is at the 4 to 5% range, this tells you that liquidity is at a premium, and we were not even getting the replace in terms of the activity in the balance sheet mix. Credit has held up, which, there's been all this focus on interest rate risk and liquidity risk, but, credit risk is usually the one that keeps us up at night. Provisioning is starting to tick up a little bit more at credit unions than at banks, but still paling to what we saw back in 2020. And then accordingly on the loan loss reserves to the loan side of things, credit unions are more or less back to where they were in end of 2019, where banks, whether we're looking at the middle of the road or on the extremes, have lower levels of reserves put away. So let's, get to section 3 and wrap things up. So Sean's going to go over a couple things on the asset side of the balance sheet. I will tackle the liabilities. And as I say that now, I realize that probably not the first time I've been called a liability, but usually I'm not the one saying it. So here I am self-reporting. Let's, Sean will go through a couple things on the asset side.
To match your self-effacement, I've been accused of being a Poindexter, so I'm going to be a little bit of a Poindexter again here and just highlight some of the fixed income terminology that we've tossed around that we just want to, I think, should be guiding folks as they think about their actions in coming quarters in this potentially pivotal time. Convexity, what the heck is convexity? We've tossed that word around a lot. Basically, positive convexity versus negative convexity. Positive convexity, positively convex assets are those things that will increase in price significantly if rates decline. And why would they increase significantly? It's because there's a lockout in prepayment. That you're assured of getting your cash flows, or more assured of getting your cash flows compared to other instruments. So think about something like a bullet bond. If you had a bullet debenture and you're getting paid, it's issued recently and you're getting paid 4.5% on it, and now rates decline a couple hundred basis points, you'll still get your 4.5% for the remaining term in that. It's a positively convex asset versus a negatively convex asset, which is something like a mortgage, and a recent vintage high coupon mortgage. So if rates do decline a couple hundred basis points, then a lot of these mortgages that have been booked in the past year are very likely to refinance in that event. And so everything that doesn't have sort of that really tight prepayment language around it is more negatively convex. In our last webinar, if you want to explore more about that, that was talked about in depth in our last webinar about protecting margins with convexity. And then to that point, let's flip over to the next one and just highlight that mortgage rates are up a lot. And so I wanted to take a look at what's the 30-year history of the 30-year mortgage rate, basically. So if we go back all the way back to the early 90s, you can see that a couple years after that time frame, coming out of that recession, the 91 recession, you get into the start of sort of the dot-com era, the mid to late 90s. Mortgage rates were as high as 9% in that time frame, and we're today at about 7%. This most recent Fed data was at 6.95 a week or two ago. And so we haven't seen these rates really since the turn of the century again. It's been 20 odd years since we've seen anything like this, and it's been about a year that we've seen rates in the sort of 6 to 7% kind of range. And so we are building up, even though inventory, as I talked about earlier, is low and volume is relatively low, we are seeing more traction in our MPF product, and I think that's happening because people need liquidity, and there's still folks out there buying homes. I think a lot of these mortgages that are coming on are probably higher risk to refi in a certain environment if there is more of a pivot coming in the next couple quarters or next year. And so, as I think about balance sheet management strategies, something to really think about is how much you really want to keep on the balance sheet of these kind of higher coupon mortgages. They look good today, but the real risk, of course, is that there is a refi boom and all these will come right back at you. And so you'll have this sort of inverse dynamic of straining liquidity today to put on a mortgage that doesn't last a whole lot of time. And then when it does refinance, now you get the liquidity back. So you have this trap of using your liquidity to get something that will disappear the second it becomes more attractive to you. And so something to think about in terms of being a balance sheet manager is how much do you really want to keep of these higher level mortgages. And again, we have the product, the MPF product, that allows you to sell those mortgages directly to us, where we basically assume that risk and frees up your balance sheet for extra liquidity.
So we spent a lot of time in section 2 talking about deposits and all the things happening there. And Sean mentioned the relatively short nature of the CDs. And we had the good fortune of being able to talk to a lot of banks, credit unions across the region. And as we go out to meetings and we talk with people, we see a lot of the same type of things, the 5% CD for 5 months, right? The odd term specials and all that. So, you know, I'll throw out what seems like an out of the box idea, but maybe as we talk through it, it doesn't seem so out of the box, is the idea of, you know, rather than trying to entice customers with the shorter terms, test the waters with the long term. Now, there's a couple of things working against us there, is that the retail customer doesn't necessarily understand or process the idea of an inverted curve about, well, why are you going to give me less interest the further out I go? But maybe the counter to that is we haven't been at these levels of rates that are readily available on bank deposits in a long time. So, right, you know, when short-term rates are at 0 and long-term rates are at 1, trying to entice someone to go to 1, good luck. That probably doesn't move the needle by math or just by, you know, personality. But the trade-off between 5 and 4, maybe 4% to lock in someone who's paying attention to the news. They hear that the pivot is coming soon, that there may be some opportunity there. And use our advanced curve to guide your pricing. So here you can see for the green bars, the shorter terms, I used less 50 basis points, and for the longer terms, less 75. So, you know, honestly, like, I think north of 5% inside of a year is table stakes in order to be able to bring in deposits. But you know, I'd ask this question and say, you know, 5% with an inverted curve for 5 months, how much is that doing for you beyond just simply being funding? What is it doing for you in terms of margin, interest rate risk, or liquidity risk benefits? Probably it's filling the gap. As a defensive measure, right? The customer says, match my rate or I'm leaving. Absolutely, keep them in the mix. But in terms of new money and training folks not to be so price sensitive, then maybe trying to tiptoe out the curve would be advantageous. And if you subscribe to the theory that the funding profile informs what you can do on the asset side, well, if you're able to move out to 2 to 3 years on your CDs instead of 5 or 6 months, well, then that affords you some ability to take a little bit more interest rate risk on the asset side, whether by loans or investments. You know, again, I'll throw out some numbers here that honestly surprised me when I looked at it, that quarter over quarter, 16% of banks increased the amount of CDs greater than 3 years as a percentage of their funding mix. And on the credit union side, it was 31%. So honestly, I thought those numbers were going to be less, single-digit numbers, especially when you consider that there's probably some roll down effect, right? Something with 3.1 goes to 2.8 over the course of a quarter. So the fact that, you know, it wasn't a majority, but there were a meaningful amount of banks and credit unions who were able to move the needle a little bit. Maybe it's something to consider when you look at the shape of the curve and where things are at. Puttable advances, the HLB option advance in particular, if you've been paying attention to us, you know that this has been on the top of the stack of the good ideas for the better part of a year, probably a little more than that. And, you know, one of the beauties of this product, other than the rate itself provides some margin relief, is that because of the customizable nature, that you can really calibrate the amount of risk that you want to take or the objective that you're trying to accomplish here. So I'll throw out 3 examples of the approaches that members have taken that are nominally within this same advanced type. But when you look at the applications, you know, they really aren't the same type of product. And we'll get into that, you know, right now. So we've seen a lot of folks who have been rolling short-term funding, whether it's overnight borrowings or just rolling 1 month, and start to peel a little bit of that amount off into using some of the HLB option, and really keeping the maturities tight and really preventing some of that extension risk. So in the example of using a 2-year potential final maturity with a 3-month lockout at 473 as of the other day, that's almost 90 basis point savings versus the 3-month classic. So you're able to capture some cost benefits, but really keeping the potential extension risk at bay. On the other side of the equation, if the motivation to really support margin in the current period is the primary goal, then the longer you go out on the potential final maturity, the lower you'll be able to push the rate. So it's similar to where because we know that the potential variability of the cash flows is greater when you have longer maturities. The same way you're going to buy a 30-year mortgage-backed security, you'd expect more spread than when you go to buy a 10-year mortgage-backed security. So in a 10-year, 6-month structure, you'd be able to get just about 200 basis points of savings versus the classic bullet. And then you want to combine some of those concepts and provide some interest rate risk and liquidity support. Well, then we've seen folks extend that lockout period to get some cost and funding certainty for a period of time. So structures like the 5-year, 1-year, again, can get to about 150 basis points of savings versus the 1-year bullet, something that many folks are doing as well. And then, we've talked a lot about a potential pivot and a move in short-term rates, so and liquidity being at a premium right now. So when you talk about those two things, rate direction and liquidity risk, the things that immediately come to the top of mind are floating rate advances. So when you look at a 9-month classic advance fixed rate versus a 9-month SOFR index advance, the day one rate is very similar, within a basis point or two. But as you can see by this graphic, the green versus the blue, that obviously the floating rate advance has a floating rate component that is comprising a bulk of the rate because rates are so comfortably above 5%. So if we do see a sharp pivot and we do see a repricing, then you're going to want funding, whether deposits or wholesale, that has that down rate beta of 1 or very close to it. And certainly the floating rate advance is going to give you that. And I go back to one of Sean's slides there and looking at that 04 to 09 experience. And the thing that really concerns me is looking at that gap along the right-hand side where Fed funds came down considerably and the deposit expense was going the other way. I mean, well, it declined a little bit, but it did not even come. Yeah, it was elevated, did not even come close to moving one-to-one with where rates would come. So that tells us that even if we see a pivot tomorrow, that deposit costs are probably not going to pivot right alongside with them. So certainly the floating rate advances are going to give you that. On the right-hand side, the other advance in the floating rate bucket would be the discount note auction floater advance, the DNA floater. We've mentioned this in previous instances, but the benefits really boil down to the 3 things you see there. So if those check boxes for you in terms of what you're trying to do and trying to accomplish, then it's going to be something that's worthwhile to consider. And I'll make a point that even if you don't see something in our daily rate email, it doesn't mean that it's not available on a regular basis. So always call your relationship manager, call the desk. We are always available to talk through this. And if the past 45 minutes and the past 10 webinars weren't proof enough that we enjoyed doing this stuff, we could talk about this for probably way more than 45 minutes. We won't subject you to that, I promise. But we'll provide whatever we're able to do for you. So, this brings us to the end. We really appreciate your time and attendance. I will say that we have some really neat stuff planned out for the rest of the year. You may have seen a save the date for CEO CFO Roundtable. That's an in-person event that's coming in November. Always something that everyone looks forward to. We have some more articles, webinars, and case studies that Sean and I will be putting forth. We also have some guest speakers coming on board. Voya Investment Management next month to talk about some bond portfolio ideas. And we also have some folks from Colliers International to talk about commercial real estate trends here in New England and nationally. That'll be coming in October. So hopefully we're providing some timely and relevant things for you. And we can continue to be there to provide all the support in whatever way, shape, or form you may need. So thank you again. We appreciate everything and hope you have a great rest of your day.